Good evening, ladies and gentlemen. Welcome to this evening's SMSF Club webinar, the first of 2021. Over the last 12 months, we've certainly had a very interesting time when it comes to the overall economy and investment markets. It's been, the hardest 12 months in my time. And as I go through tonight's presentation, I'm sure you'll have a clear idea why it's very difficult when you sit in my seat and try to come up with investment strategies and investment guidance for SMSF Club clients. What's an interesting time, we go back to, I suppose, fundamentals and try to be not be distracted by the noise in the overall economy, the overall market. And one person I've always drawn upon during times of adversity is Warren Buffett, who we can see on our screen. Warren Buffett has always said that cash combined with courage in times of crisis is priceless. He's also said the time to buy is when there's blood in the streets, and he's also said the time to be greedy is when all others have been fearful. That's been a message that I've been trying to portray to my clients and many investors, certainly March, April, May last year, and have repeated myself constantly over the last 12 months. And that has certainly paid for those people that have listened. So tonight's presentation, we're going to go through a few things. Bear with me one sec. Hopefully everyone can hear me. If you could put in the question section that you can hear me loud and clear, that'd be great. And if you could see my screen, that'd be outstanding. All clear, you beauty. Thank you. What's interesting is that looking at the number of attendees, it's certainly been a record over of amount of people that have tuned in tonight in comparison to the last 12 months. So it's great to see SMSF trustees taking their obligations seriously. Now, I know there's a lot of distractions. We've got a holy moly coming up in the not too distant future. Other things for many of our clients and many other SMSF trustees where they get distracted from taking their trustee obligations seriously. So I do applaud you for tuning in tonight, because after all, it's not just your contributions that is going to contribute to the lifestyle you live in retirement, but also the returns. So thank you for tuning in to hear about what's going on in the global investment markets, and for me to give you a bit of an outlook as to what I hope will happen over the next 12 months, 3 years to 10 years. Before we get into the outlook and what's happened, I do need to go over our disclaimer. The SMSF Club and myself as an individual are licensed by Finexia. They hold an Australian financial services license. And tonight's presentation is what they call general advice. General advice is advice where I haven't considered your individual circumstances. We have a lot of different people online, different age brackets, different risk profiles, different investment experience. Some people like shares, some people have a preference for property or fixed income investments. So I haven't considered any of those personal circumstances when I've put together this presentation. It is just a general market update. It's my view. I do not have a crystal ball. My crystal ball is clouded, but I hope to draw upon what is now almost 25 years of investment experience and 20 years as an investment advisor to help guide you through these adverse market movements. And the volatility that exists in the current market is where we actually deliver the value that you pay for us. A rising tide lifts all boats. It's generally when the tide goes out that a true investment advisor proves their wealth. And I think over the last 12 months, we've done exactly that for those that have listened. So look, we're going to come up with forecasts, and look, as I said, they're my guests, and they're somewhat, hopefully a little bit educated than most. But if I go back to year 10 at my school at Central Coast Grammar School, I do recall Mr. Thickett, who was my economics teacher. He had a big poster on the wall that said an economist will tell you today why what they predicted yesterday didn't happen. So hopefully that gives you a bit more certainty in the outcome of some of the forecasts that we make. So after all, past performance is an indicator of future performance, but we hope it is a bit of a guide and we can learn from that, hopefully. So why is the economy booming? That is the topic of today's webinar. The last 12 months, I'm not too sure about you, but the last 12 months has been somewhat the hardest of my time. If you go back 12 months ago, in January, we had the flood, we had fires, and of course, we've had COVID-19 and the economic response since. It's been a very dramatic time indeed. But since those economic crises, economies of the world, governments of the world have stepped in and provided huge stimulus packages that has meant the economy, the share market, the property market, most investment sectors of the globe have been booming. So tonight's webinar is to give you a bit of insight as to why that is the case. So the agenda, we'll go through 2020 in review, current investment trends, the tailored investment solutions for many of you that have invested in the tailored investment solution products. I'll go through each of those from a macro level as to their performance. Investment trends of 2020, which has been quite phenomenal, and the 2021 outlook, most importantly. If you do have any questions, please put your questions in the question section, and I'll attempt to answer it along the way. I may get on a roll, so I might not see a question, but I'll endeavour to look at questions as I go. I'll eventually come back to it. If I do miss it, we will have a time at the end to cover questions, hopefully all before Holy Moly starts, which I doubt is going to be the case. Why is the investment economy booming across the globe? Let's look just here specifically in Australia. Two of the ways that the government influence the economy. The first is through interest rates. What happens is that if the economy is it needs a bit of a speed up, needs a bit of a boost to ensure unemployment stays low, confidence stays high. What the government does, or the RBA does, the Reserve Bank of Australia, is that it moves interest rates. So to stimulate the economy, they cut interest rates. Now we see there on a chart, since 1990, if you go back to the late 80s, interest rates were almost 20%, which was great for retirees, but not too good if you're a borrower in the accumulation phase of your investment life cycle. Interest rates were cut in the 90s. We had the Asian banking crisis, mid-90s. Since then, interest rates have stayed below 10%. 2007, the GFC happened, which was interesting here in Australia, which was probably different to everywhere else in the world. The official interest rate increased, which we can see there from 2009 to 2012, where the official interest rate went up to about 5%. So if you remember, we don't need to go back too far. Don't worry about going back to the 80s. It's a bit of a different economy now. Things work in a somewhat different environment. But if we just go back to 2010 to 2012, the official interest rate was 5%. So 2012, if you had money, a mortgage on your home, you're paying around 7%. Now, if we move forward to 2020, the official interest rate was below 1%. And in response to COVID, in the hope to stimulate the economy, the RBA has cut interest rates aggressively. It's cut interest rates to what is the official interest rate is 0.1% right now. This is one way the government stimulates the economy. They cut interest rates. So how does that stimulate the economy? What we've done is not just stimulate the economy, but just last week, the RBA on the 2nd of February met and they came out and said that they're not intending to lift interest rates until 2024, in that they expect the official interest rate for the next 3 years to stay at 0.1%. Maintaining the interest rate at 0.1% was expected. What was not expected is them to benchmark that to say that it's going to stay at that level for the next 3 years. In addition to the unexpected announcement that they're going to basically benchmark it at 0.1% for 3 years, is that they've come out and said they're going to increase their bond buying program by another $100 billion. $100 billion. Now, that figure cannot be underestimated. That figure is huge, right? So the fact that the RBA left interest rates on hold is no surprise. We expected that. But the announcement that they're going to be printing another $100 billion and flooding the market with cash is huge. That increases pretty much, if you combine it with the amount of money they've printed over the last 12 months or 6 months since COVID, has meant that it's tripled the amount of money in the economy. Tripled. That cannot be underestimated. That is huge. And when we look at the interest rate cuts, combining them by the amount of money the RBA has injected into the economy, the hundreds of billions of dollars that over the last 9 months they've injected into the economy, is the main reason why we've had not just an economic boom for the last 9 months, but why I expect it to continue for the next 3 years. This is why I anticipate the share market here in Australia, the property market as a broader term, is going to continue to rise like it has over the last 6 months. Now, they're big, broad statements, but they're backed by the fundamental reason that we've got so much cash in the economy. We'll go through that over the course of the next hour. So how does interest rate movements influence the economy? Let's have a look at it. So let's have an average home loan of $500,000. So let's say you've got the average Australian's got a home loan of $500,000. If we go back to 2012, when the interest rate was 6.99% on that home loan, the cost of keeping a $500,000 loan would be $34,950, call it $35,000 in interest-only expense per annum in after-tax dollars. So it costs you 35 grand in after-tax dollars. So $700 a week in your capital is going just to meet the interest repayments on your home, okay? If we move forward to where we are today in 2021, you can borrow fixed for 4 years at 1.89%. So if an interest-only loan for $500,000 is only going to cost you $9,450 in after-tax dollars. That means the average household has $25,000, $500 a week, every week to spend how they like. They're $500 a week better off just because the interest rate is less on their home. When we've got 25 grand in our back pocket, we're spending that or saving it. We've seen the savings level here in Australia go up rapidly. That's not just because we're reducing our biggest expense, being the interest on our home loan, but because we've got less places to spend it. Right? We can't travel overseas. Travel has been restricted in many states. We've been in lockdown, so we've been seen the household savings level increase dramatically. I'll get into that in a moment. The main thing I want to highlight is that for a $500,000 home loan, we are $25,000 better off per household in after-tax dollars. Now, if that money gets spent, we've got in our back pocket, we spend it. It might be, you know what, I want to go out and buy another home, and I'm going to increase my home loan from 500 grand to $1 million. So that demand increases the property prices. It may be, you know what, I'm going to go spend that money on electrical appliances. I can't go out to dinner, I'm going to go buy more cooking utensils. I'm going to go buy more TVs. I'm going to go buy more entertainment things like jet skis, boats, right? The money goes and gets spent in the economy. Now, these are the decisions that we're seeing many Australian households make. It may be that they're spending money on the TAB and gambling, right? There's just more money flowing in the economy. More people have got disposable income in their back pocket they can use for whatever they like, rather than merely just meeting the interest on their home loan. That has a dramatic effect on the overall growth of the economy. It has a dramatical effect on the share prices of the companies that are benefiting from this. So we're seeing record profits happen from a lot of different companies in a lot of different sectors of the Australian share market right now. Why? It's just because more people are spending more money. JB Hi-Fi, record sales. Harvey Norman, record sales. Right? Woolworths, record sales. So all these things is relating to, comes back to the government's decision to cut interest rates. It puts more money in our back pocket, provided we've got the confidence that we can, that we've got job security, we'll go out and spend it. And that's what's happened over the last 6 months, which has caused the economy to boom, the share market to boom, and property prices across most capital cities to increase in value. So we're in a booming economy. First way is because of interest rate cuts. Then we've got this dramatic effect of the government or the RBA printing money. So if we go back to 2013, 2014, the balance sheet of the RBA, the debt, it was around $100 billion, right? Now we're going to be close up with the latest $100 billion of government stimulus that was announced only last week to be close to $450 billion. That's almost quadruple the amount of money that was in the economy just a few years ago. So we've got a tidal wave of money in the Australian economy. It's committed to expand the balance sheet even additionally by another 100 billion. So it's triple the amount of money in the economy over the last 18 months. If we put the other 100 billion, it goes to 450. If we go back to 2013, it's almost 4 times the amount of money that was in the economy, which is huge. Now I received an email which was from an economist, and it sort of reiterated what my thoughts were. I'll just read it out to you on this point. Hi, Justin. Okay, I'm not seeing enough people making a big deal about this, so maybe people just don't get it. As I flagged last week, the RBA left interest rates on hold. They announced the printing of another $100 billion and flooding the market with it. That was a surprise, and frankly, it's huge. The RBA has unleashed a tidal wave of money in the Australian economy. It is massive. This is one of those terms that I think is designed to sound cute and actually kind of hide from the public what's actually going on. So the RBA says it's expanded its balance sheet. How does it do that? Well, it purchases assets, because that's what goes on a balance sheet. Namely, it purchases government bonds. So where does it get the money? It prints it. It just flicks a button and prints it. And the amount of money in the economy goes up as a result. So it's money printing. That's what's actually going on. But no, let's be cute and call it quantitative easing or expanding the balance sheet, whatever you like to call it. Anyway, so this is what the RBA balance sheet looks like. I'll show you the chart there ahead of you. So you can see in front of you, we're hovering around $160 billion in the lead up to COVID. Since then, we've expanded by another $160 billion. So it's doubled. So the current bond buying program runs until March at the pace of $5 billion a week, after which will be followed by another $100 billion. So in 18 months, the RBA balance sheet, which remember is another way to think about money in the economy, will have expanded from 160 billion to about 450 billion. That is, it's tripled. Do you get what's happened when it tripled the amount of money in the economy in such a short term? In particular, do you know what happens to asset prices when the money suddenly triples? What happens? It goes through the roof. This is a big deal. But I don't see anyone making a big fuss about it. Maybe because it's disguised in all the economic babble about quantitative easing expanding the balance sheet. Maybe it's designed to stop ordinary people clock what's actually going on. So what's going on? A massive explosion in money supply is going to cause a massive explosion in asset prices. But that's a secret you're probably not meant to know. That was the email I received from an economist and a good friend of mine. Right? Some of you may have received the same email. What I want to try to do is like put that email into the information that you can understand and maybe identify some of the asset classes you can invest in as a result. All we need to know now is that the government has got 2 ways to influence the economy to make it boom: to increase confidence, to reduce unemployment. The government's aim is to keep unemployment low, inflation at a moderate level between 1% and 3%, and increase confidence. The way it does that, reduce interest rates and just print money. And this is the balance sheet that shows us that we're printing money. Now, many people are concerned about printing money. They go, well, what are we doing? We're borrowing money, we're printing money. What actually happens? Who do they pay it back to? What happens? Essentially, what happens is that if Australia was merely printing money and no one else in the globe was doing exactly the same thing, then our currency would be influenced by it. But when everyone in the globe is printing money at the same rate as Australia has done so, then the currency should stay about the same. What we've seen is actually the Australian dollar appreciate against the US dollar, despite all the money that we're printing here domestically. The reason why is because despite Australia and the RBA increasing the amount of money in the economy dramatically, it's doing it at a lesser rate to the US economy. It's doing it at a lesser rate than the majority of the modern economies in the world. So despite us increasing the levels of debt or printing money, the fact that a rising tide lifts all boats and we're not increasing at the same level as the rest of the globe actually means that future generations are going to be in a better position than the majority of other countries around the world. So it's okay at the moment. The other thing is that we've got the ability to increase the quantity of easing, injecting capital into our economy if needed, just to catch up to the world, which is a great position our economy is in. It gives us a competitive advantage against many other economies in the world. Savings level, as I mentioned before, where we sit at the moment, the savings level here in Australia has increased dramatically from where we've been in the last 20 years. In fact, you've got to go back to the mid 80s where the savings levels is higher than where we are today. The reason we've had savings levels increase is twofold. One, interest rates have been cut. So the majority of our main expenses have been cut considerably. But also we've had less ways we can spend our money. We can't travel overseas. Domestic travel has been somewhat difficult. So because we haven't been able to spend money, Melbourne, Sydney in particular, Perth, Adelaide, and lesser extent to Brisbane, we've been restricted in the ability to spend money. We haven't been able to go down to the corner store to buy a coffee. We haven't had to travel for work. We've been working from home for a lot of people. So all those things mean that we've reduced our expenses. Because we haven't been able to spend it, it's increasing our savings level, which again puts us in a very strong position to ride through the turmoil, in addition to the government stimulus. So let's look at how that responds to the share market. That's a share market over the last 3 years. So it takes us back to January 2018. Let's focus on the last 12 months, which is the interesting period. If in fact we go back to 12 years ago, so pre-GFC, 13 years ago, back to 2007, the Australian share market is essentially trading at exactly the same level. So we've traded sideways now for 13 or 14 years, which is somewhat frustrating coming from an individual stockbroker who has a lot of my money invested in shares. But despite the market going sideways, we've been able to extract some good returns for investors over that period for different reasons. Let's go through some of those reasons. One big thing has got to do with timing. So the last 12 months, we saw in January, the market was just below 6,700 at the start of January 2020. So we're going back to the beginning pre-COVID. The market fell 36.5% due to COVID. Since COVID, the market is up 45%, 44.9%, which is a phenomenal recovery. If you look at us on year, from the January 2020 to where we are today, the actual share market is up 3%. So had you not looked at the share market, not turned on the computer at all, not turned on the TV, not looked at the news in any shape or form, and you looked at where the share market was in January 2020 and where it is today, it's up 3%. That's not too bad. But unfortunately, majority of investors look at the volatility and measure this every day. They look at the noise in the marketplace and what's going on. And for many people, that created a lot of losses. And for a lot of other people, it created a great buying opportunity. And that was the case for many of the SMSF Club investors, which was outstanding, as they took advantage of the market weakness as a result of COVID. However, while we look at the Australian share market over the last 12 months, if we compare the Australian share market to the rest of the world, we've underperformed. Even though we've recovered the majority of our losses since COVID, we're almost at all-time highs. We're only 100 points from where it was at a high level back in March last year. Despite that, we've underperformed the majority of our other trading partners. Our main trading partners are Japan, China, and the United States. So if we look at that chart, the green line is actually the performance of the Australian Stock Exchange. ASX 200, the largest 200 companies here in Australia. So despite us rebounding pretty much back to those highs in March 2020, certainly rebounded to a higher level of where we were in January 2020, we've underperformed all of the other big trading partners of Australia. The blue line is America. As you can see, the Dow Jones, as the measure of the US share market, has outperformed Australia. The blue line is the Nifty 50, which is India. The red line is Nikkei, which is the Japanese economy, Japanese share market. The yellow line is the NASDAQ, which is the largest tech companies listed in the United States of the world. The gray line is the measure of China. So despite our market recovering almost 45% from the lows, it has underperformed all other trading partners. So I think the Australian share market has got to do a little bit of catch up. Many people say that you become the average of the people you spend, maybe the 5 people you spend the most amount of time with. So choose those friends wisely. From a share market, we should be the average of our largest 5 trading partners. So our 5 trading partners is the US, China, India, Japan, and Indonesia. I don't have the Indonesian share market on that chart, but they are 5 largest trading partners. We should be the average of that, not the worst performer. So I think we've got a bit of catching up to do, personally. So if we go through it, we've got back in January, Celeste Barber. If you remember, we had the Australian fires. The headlines around the globe was Australian burns. Celeste Barber, that is a comedian, raised $30 million for charity. And across the globe, charities raised a lot of money for fires here in Australia. Soon that was replaced by floods, followed by the fires, the world's worst fires that we've seen. We had the heaviest rainfalls in 30 years, which created floods, certainly across the eastern seaboard. And we've had the COVID-19 outbreak. In March, in a response to COVID-19, the RBA cut interest rates for the first time. So cut interest rates to 0.5%, which is the lowest level at the time in history. Interim month, which is very rare for the RBA to meet. If you remember, halfway through March, RBA met on a emergency meeting. They cut interest rates again. So they cut them by a half, from 0.5% to 25 basis points. Then the government introduced its first stimulus package. Now, at the time, if you remember, they had a shutdown. There was lines out at Centrelink. It was a bit of a bloodbath. It was mayhem. If you're like me, there was a fair amount of uncertainty. And I was scratching my head thinking, this is the worst I've ever experienced. The streets were bare. People were told to stay at home. We're in lockdowns across the country. There was a huge amount of uncertainty. If you're like me, you're losing sleep. You know how you're going to put food on the table, how you're going to pay for your kids' education. The government were in a crisis. Our economy and the global economies were in a crisis. We're in a bloodbath. The governments across the globe in unison came out with huge stimulus packages. The initial COVID-19 response here in Australia totaled just on $299 billion. It included massive health measures, JobKeeper, JobSeeker. We've got small business concessions. We had the employers' cash flow boost, coronavirus supplement. On 30th of March, we had JobKeeper that actually began. We had money handed out. We had the access to the ability to access our super up to 10 grand in 2020, another 10 grand in 2021, and hundreds of thousands of people took advantage of that. Later on, the government came out and stepped up JobKeeper number 2 after the economy created a bit of stability after their $300 billion stimulus. They extended it from September to March. However, it was scaled back somewhat. Have they announced another 36 billion in super withdrawals, a recovery plan? No doubt in March, when those JobKeeper things expire, they're going to be watered down somewhat and extended again. So there's huge government stimulus in response to the uncertainty that was created due to COVID. The shutdowns of economies, sectors, borders meant that the government had to step up and stimulate the economy to create certainty, to create jobs, to ensure unemployment didn't increase. And they did that massively. They took massive steps and they continue to do so. As a response, if we go back to mid-March, the ASX jumped 7% in one day, which was its best session in 40 years. JobKeeper was extended in September. The Australian economy in September was officially called to be in a recession, which was the first time in 30 years as GDP fell for 2 quarters in a row. It was down 7% for one quarter, which was 3 times worse than the previous worst in history. We also, during that time, commenced a trade war with China. If you recall, there was issues with China putting increasing tariffs on our wine exports, and that expanded to a lot of other sectors, not just the wine industry in Australia. So our biggest trading partner was starting to tighten the screws on Australian exports. However, during that time, despite all the uncertainty, we had household savings. It increased to a record high, jumping from 6 to 19.8%. RBA cut interest rates again in November, and that was cutting it to where we are today, 0.1%. Then we had the US election with the Trump debacle. The US election wasn't won. There wasn't conceded at that time, but eventually time has conceded where Biden has taken over. So during that period, there was a lot of US political uncertainty with Trump causing a lot of noise as to what's going on. He certainly didn't leave without creating noise, like he didn't turn up that way. Australia was officially announced to be out of recession in December. So you look at what we've done over the last 12 months, it's been a busy time. There's been a lot of noise in the marketplace. There's been a lot of headlines, which has meant that when it comes to being an investor, you're sitting back going, shit, what do I do? And when that question is posed, the majority of people put their head in their sand and do nothing. And that's unfortunate because it's during these adverse, uncertain times that the majority of money has been made. And that's been throughout history. Warren Buffett says you pay a very high price for certainty, but uncertainty is the friend of an astute investor. And had you invested over the last 12 months, your returns would have been phenomenal. Well, not so much 12 months, but since March, it's been phenomenal. So it wasn't just here in Australia. Well, we've had billions of dollars spent in government stimulus. If we go to Argentina, 21 billion, 5% of GDP was spent. Almost 10% in Brazil, almost 10% in Canada, 7% in China, 10% in France. This is the percentage of GDP that was spent on stimulating the economy. Germany, 25%. India, 5%. Indonesia, 5%. Italy, 14.6%. Japan, 18%. Russia, 2.5%. Although I'm not too sure if those numbers are accurate. Right, if we go across, if we get the actual picture, United States, 13.6% of the GDP has been spent the last 9 months in stimulating the economy. If we add that all up, it's $11 trillion. $11 trillion has been spent by governments around the globe to stimulate the economy. And that was in response from March to April, 2 months. That's how much they injected in the economy. That does not include how much money they spent post-April to continue that economic growth and certainty. $11 trillion was the immediate response in the first 2 months of COVID hitting the economy that governments around the world spent in ensuring certainty, ensuring unemployment stayed low. They took massive steps, and Australia was just one of those. All this money injected in the economy has meant the majority of share markets around the globe, the majority of economies have been booming. Employment growth is the last 12 months. We look at April 2020, go back there, 600,000 people lost their job. May, 265,000 people lost their jobs here in Australia. This is why the government spent so much money to get them back in the workforce. In June, they almost offset all of those people that lost their job in May. 226,000 people lost their job. Were rehired in June 2020. Well, 265,000 people lost their job and almost offset that. So as you can see, we've seen, in response to the economic measures, employment increase and almost offset those declines that we experienced in April and May. GDP changes. So this is going back to 2015. Here is the response for COVID. As we can see, 0.3 decline, negative 7%. 2 negative quarters meant we're in a recession. Since then, we've rebounded 3.3%. So our economy is booming. So Warren Buffett, if we get back to investment markets, look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. The time to buy is when there's blood on the streets. Be fearful when others are greedy and greedy when others are fearful. These are statements that I've been saying over and over again, not just over the last 12 months, but over the last 20 years as an investment advisor. And they've come so true in the last 9 months as markets have rebounded. My personal investment ethos is don't try to pick the next GameStop or Bitcoin. I'll get into them in a moment. I do not try to be lucky. I merely stick to assets that have a long-term track record of providing superior returns to investors, consistent returns over 40 to 50 years. Then I diversify. I'm a big believer in diversification, so much so that I created a board game based on it. You don't just put all your money in one asset class because the chances of you dropping that basket is high. You don't have all your eggs in one basket, so you're spread across different asset classes in the hope that you're going to provide good returns over the long term. And that long term is for retirement. If we look at what we're talking about today, superannuation. Super is meant to last you until you die, right? You're meant to be providing you an income stream so you don't become a liability to the government. So when you're 90, you should be sitting back, living off the income that you earn from your superannuation. And I know for the majority of you as listeners, in fact, all of you, 90 years of age is decades away, right? You take long-term views. Just because you have a self-managed super fund, that does not mean you go on the next quick buck scheme, right? You got to treat it as if it's your own money. You got to be patient, take long-term views, and buy quality assets and hold for the long term. I heard a quote today that you buy well and never sell. That's the idea of investing. It should be the idea of you investing, especially when it comes to superannuation. So if we look at the tailored investment solutions over the last 12 months, or us as investment advisors, we've launched a few investments in this time. If you go back to late March, we came out with 3 investments. The tailored investment solutions ASX 200 Series 3. The average level was 5,126. We then came out with a wholesale trade to gain exposure to ASX. Again, 5,305 was our entry level. Then we came out with the 3rd ASX investment, right? During that month when the market was volatile, I was allocating a lot of capital. I was talking to you as investors. We ran a lot of webinars during that period to encourage people to take the long-term view and buy when there's blood on the streets. We came out with a diversified property investment that gave people exposure to a diversified property asset, an ETF, which is was a $20 billion worth of listed property assets listed on the Australian Stock Exchange. We came out with an investment that gave people exposure to the 5 largest billionaires in the world for global exposure to their portfolio, not just focusing on the Australian economy. Then came out with a Berkshire Hathaway Series 3 extension investment. In late April, we extended our Series 3 investment by another 3 years. Then we came out with another Berkshire Hathaway extension series, which was in September. So we've been very, very busy over the last 9 months, taking advantage of the market weakness. Here's all of our investments that we have open right now here at Tailored Investment Solutions. Right, if you go back to the start date of the Berkshire Hathaway Series 2 extension, it goes back to February 2018. So these are the ones that are currently open. It is up 13.5% despite the volatility that we've experienced in Berkshire Hathaway over the last 12 months. ASX Series 1 extension, it's up 7.7%. It matures in June. We have the global credit investment, which is the first time since we actually invested that it's in the green, it's positive. While it's positive, it's only up 0.6%. That's the first time since July 2018 that it is in the green. ASX Series 2 is up 2%. Berkshire Hathaway Series 5 is 16. Gold. One of the reasons we came out with gold in December 2018 was to protect ourselves as investors against an adverse global meltdown, which has occurred. As a response, gold has increased dramatically. It's up 42%. Berkshire Hathaway Series 6, which was March 2019, is up almost 15% today. Series 3, ASX Wholesale, Series 1, Series 2, Diversified Property Global Billionaires. If we look at those ones, they're the ones that we've invested in the last 9 months since March. So since COVID, the returns have been phenomenal as we've taken advantage of the market rebounding. We're up 34.2%, 29.7, 32.3, 29.6, 27.65%, 28.4, 10.12. These returns are phenomenal when we're talking about in a period less than 12 months. This highlights the reasons why we need to be greedy when others are fearful and buy when there's blood on the streets. Had you invested in these products, you're on very, very good returns right now, which is great. The last one is Gold Series 3, which we launched in October, only a few months ago, less than 6 months ago. It's the only one of the current Tailored Investment Solutions that are open that is down, and it's down only 4%. So the returns of our assets have been phenomenal despite the returns. Even if you invested prior to COVID, they're in the green. Had you invested post-COVID, the returns are phenomenal. They're not the returns like Afterpay. They're not the returns like GameStop. They're not the returns like Bitcoin. But all of those things, if you invested in them and invested a lot of money and made a return, then great. I don't try to buy the next big thing because I think it's too risky and you only generally invest it by luck. What I try to buy is asset classes that have a long-term track record of providing a return to investors. I try to buy when I think they're cheap. And we've done so over the last 9 months. So in the short-term investment markets, whether it's property shares or voting machines, but over the long term, they're a weighing machine. What that means is that in the short term, it's dictated by price, which is demand and supply. Over the long term, though, it's fundamentals. And that fundamental reason is merely profits. If a company's not going to make profits in the future, then it'll eventually go broke, right? So the only reason you should be buying an asset, especially in your superannuation, is to hold it for the long term and to extract an income in retirement. The sole purpose of superannuation is to provide you an income in retirement. And that's why we look at companies that have got a track record of providing a return over the long term. That's why we look for assets that have got a long-term track record over 40 or 50 years of providing investors a return. Now, I might miss out on the quick buck, and I've missed out on a lot of gains over the last 12 months. I've missed out on the buy now, pay later boom. I've missed out on the cryptocurrency boom. I've missed out on the GameStop craziness. I've missed out on a lot of opportunity, but creating wealth has got nothing to do with picking the next big thing. It's got to do with preventing the losses when you're wrong. So you don't need to take on huge risk. You didn't need to take on huge risk over the last 9 months to provide a return. We could have just bought an index ETF and you're up 30, 40%, right? You don't need to go for that quick buck scheme to make huge returns, right? Just be patient, long-term investor and buy when the majority of people are fearful to do so. So over the last 12 months, and certainly now, we've got a lot of short-term uncertainty. We've got the coronavirus, we've got China trade wars, we've still got US political instability, and who knows what else as a reflection of that. Who knows when we're going to have a vaccination? Who knows how good the vaccination is going to be? What sort of impact it's going to have on all generations? Who knows when the borders are going to be open again and the economy go back to normal? We don't know. They are uncertain. If we look at the key long-term drivers of growth, we've had huge tax cuts. We've had interest rates that have been cut to bugger all. We've got a lot more money in our back pocket than ever. We've got huge savings when it comes to household savings levels at record high levels that we haven't seen for 30 years. We have big economic spending, triple the amount of money that we had only a few years ago are going in the economy. We've got earnings growth as a result of all of that. So if we look at long-term drivers of growth, the actual facts, those four things there offset all of the short-term uncertainty that many people are going to be fearful of. And so it's 4 points that I'm confident that in 3 years' time, when we look back at where we are today, that the economy, the share market, the property market as a broad term is going to be a lot higher than where we are today. There's way too much money in the economy to prevent that from happening. Now, sure, there's going to be stocks that are going to go broke. There's going to be stocks that are going to go up 100,000-fold, right? There's going to be properties that are going to go down in value, and there's properties that are going to go up in value by a lot more than the average. But as an overall economic point of view, I'm very bullish on the outlook for the Australian economy. Not just the Australian economy, but the global economy, as governments across the world have sent a clear message that they'll do whatever it takes to ensure unemployment stays low and confidence stays high, irrespective of the cost. That is their message, and the Australian government has been no different. So in the short term, the market is a voting machine, but in the long term, it is a weighing machine. Let's have a look at some of the short-term investment trends right now. The only true long-term dictator of price is profits. Keep that in mind as we go through these few asset classes. Bitcoin. Now, look, I got it wrong. I have not been on the cryptocurrency wagon. In fact, as a licensed financial advisor, I'm not licensed to recommend it. I'm not licensed to even talk about it from an investment perspective. Why is because the general investment market, the financial planning sector, ASIC doesn't view Bitcoin as a financial product. Can't talk about it, can't recommend it. But despite that, if I could talk about it, I wouldn't recommend it, right? For super, I cannot generate an income out of a Bitcoin, right? I cannot see the fundamental reason why Bitcoin would go up over the long term. I cannot see it. And look, I don't know enough about it. A lot of you as listeners know a lot more about it than I do. So don't look down on me because I'm saying that I don't know anything about it, right? What I do know is that throughout history, there's been different sectors, like the technology sector in the early 2000s. There's been the tulip in the 1800s, right? There's been plenty of things that have gone up in value because it's been like a voting machine. People gain more confidence in that underlying trend. The only true long-term dictator of price is the ability for people to make a profit. So Bitcoin is phenomenal. Like the growth, had you invested in Bitcoin in 2015, 2016, 2017, 2018, 2019, 2020, you would have made a lot of money out of Bitcoin and capital growth. Have you sold now? But likewise, that we had in the early 2000s, the tech bubble. A lot of the tech companies back in 2000s went broke, right? I think where we are today is a lot of the cryptocurrencies are going to be broke. There's thousands of cryptocurrencies, and a lot of them are going to be worthless in the not too distant future. No doubt, though, the movement of blockchain, the movement of crypto, some of these things will go on. They will go on to a great success. I don't know which one it's going to be, and I'm not willing to have a punt on which one it's going to be as a result. And if it comes down to a punt, I'm not going to invest in it. I'm not a gambler. I'm certainly not going to be gambling with my self-money super fund assets. And for that reason, I don't invest in it, okay? This isn't advice. Like, if you know more about Bitcoin than I do, after all, Warren Buffett says, invest in what you know. If you know Bitcoin, obviously, potentially a lot more than I do, then by all means, invest something into it. But don't invest all your hard-earned cash into any asset, whether it's Bitcoin, shares, or property, or Afterpay. Make sure you diversify. But over the last 12 months, the investment trend into cryptocurrency has been phenomenal. We can see that with the Bitcoin share price. Not just at 12 months, but over the last 5 years, it's been phenomenal. I wish I bought Bitcoin. I wish. But hindsight is a very valuable thing. 3 years performance. I don't want to look at that chart. It's an amazing chart. Had you invested at any time over that period? Afterpay, buy now, pay later. I don't know why the buy now, pay later sector is booming when savings levels are at such high levels. It's essentially, I'll buy now, but I won't pay it until a future date. And I'm willing to pay a huge amount of money in the interim for it. Now, Afterpay has gone from what was $10 in mid-March to over $150 today. It's a phenomenal growth. To put it into perspective, it is worth more than the majority of the big blue chip companies that are listed on the Australian share market. Yet, the majority of its profits comes on not on income, but people in fails fees. So when you borrow money in Afterpay, you've got interest to pay back, right, on a monthly basis. $28.4 billion was what Afterpay generated income from late fees, just late fees. So if you don't pay a month, they charge you, I don't know, a $50 late fee payment, which is almost half of the Afterpay's profits. Half of Afterpay's profits are coming from late fees. Surely that isn't sustainable, right? Despite that, the share price surges. Now let's compare Afterpay in the total value of their company in comparison to all the blue chip companies listed on the Australian share market. Right, last week, Afterpay was worth 42 billion. Now it's gone up today, so it's probably more than that, okay? $42 billion. AMP is a company, is a diversified financial services company. It's worth 5 billion, just 5 billion. Afterpay is almost 10 times the size of AMP. IAG, Insurance Australia Group, which is the owner of NRMA, it's worth 13 billion. Right, so Afterpay is almost 4 times the size of NRMA IAG. QBE is worth 12 billion. ANZ, one of the top 4 banks, is worth 78 billion, which suggests Afterpay is worth more already than a half of ANZ. It's worth half of ANZ where we are today. NAB, 82 billion. Again, Afterpay is 50% of the size of NAB. Westpac, 70 billion, which includes Westpac and St. George. So if you separate Westpac and St. George, Afterpay is now valued at more than Westpac as an individual company. Afterpay is worth more than St. George Bank as a company. Commonwealth Bank of Australia, 156 billion. It's a third of the size of our largest company listed in the Australian share market. Now, they're all financial services companies. Let's move away to Woolworths. Woolworths is 52 billion. So Afterpay is almost worth the same as Woolworths. It's worth twice the size of Coles. Telstra, it's worth more than Telstra. Telstra is worth 37 billion. Now, I'd be okay if Afterpay's valuation was backed on profits, but let's have a look at it. 44 million. Keep in mind, 28 million of that 44 million is merely in late fees, right? 44 million, 28 million of that is in late fees alone, the $50 a month for people failing. So their entire business model is giving people money and then failing on their interest expense. And when they fail, they make more than half their profits. It's madness. Let's have a look at AMP. Despite it being almost a tenth the size of Afterpay, it made almost 20 times the profit of Afterpay. Almost made $1 billion in profit. IAG, 741 million. QBE, 712 million. Now, this is the profits of last year, even after we take into consideration the impact of COVID. ANZ, 3.6 billion. NAB, 2.6 billion. Westpac, 2.3 billion. So we're talking billions here, not 44 million. Despite that, Afterpay has got a huge valuation on the market, which implies that its growth has to be 10 times that of everyone else just to justify its current valuation. Coles, 1.4 billion. right? Telstra 1.8 billion. So if we correlate profits, after all, as Warren Buffett says, profits is only dictator of long-term value, then Afterpay is either got to have phenomenal growth, like record 10 times out of any of these other companies to justify their valuation today, or they're overvalued. Now, for me, that just means I won't buy Afterpay, right? I look at some of these other companies and go, well, what's a good value, what they're worth today with their future profit capacity? Afterpay doesn't make sense. I'm not going to short it. That'd be madness, as we've seen, and I'll get to in a minute. GameStop, but I'm just going to let it go through to the keeper. I'm going to avoid it. I won't buy it. What I look at that is that Afterpay and their share price is being influenced by market madness. As Benjamin Graham said, it's a voting machine in the short term dictated by demand and supply. Obviously, there's a lot of demand, which has pushed the share price up to historical levels. Some people will say unsustainable levels. But the same thing was said for Tesla. Let's go to Tesla. Tesla, what an amazing stock, right? Tesla as a company now almost has $1 trillion valuation. If you add up all of the other car manufacturers, Toyota, Volkswagen, Ferrari, BMW, Holden, General Motors, if you add up all of their valuations, you combine all of them, right? Put them all together, they're still not worth the same amount as Tesla, right? Which implies that every car we go past, there should be more Teslas than anything else that we see combined, which isn't the case, right? Tesla is not producing the same amount of cars as every other car manufacturer combined. So something must be wrong. Or the market is anticipating in the not too distant future that every car that we drive will be a Tesla, right? Which at the moment is hard to fathom, merely because of the price of the Tesla. But like Afterpay, where Afterpay is relying on fail fees to make up a profit, Tesla is relying on other car manufacturers paying them for subsidies, for environmental tickets. So the profit of Tesla has only come about because other car manufacturers are paying Tesla for their credits because they are not good for the environment. So again, they're only making a profit because of government stimulus, right? Government intervention, which is madness. That is not sustainable. Yet, have a look at the Tesla share price. It's phenomenal, right? It's phenomenal. And I would have told you this 6 months ago. And if you invested in Tesla 6 months ago, you've doubled your money, right? I would have told you this in Tesla 12 months ago, 2 years ago, right? It's not a reason not to avoid making a profit. It's not a reason to avoid making a profit. Like, after all, when it comes to investment success, it's got nothing to do with the money you make, right, when you're right. It's got to do with the money you keep when you're wrong, right? Investing in these speculative investments, whether it's Tesla, Afterpay, or Bitcoin, it's fine for a small amount of your portfolio, but you wouldn't put all of your money into these stocks because they're the latest quick buck schemes. A lot of people have made a lot of money over the last 12 months. What I'm here to highlight is over the last 12 months is that there's been huge opportunities that existed, right? I haven't invested in any of these ones personally, but I have invested in the ASX. I have invested in Berkshire Hathaway, right? I don't care if I avoid making a double bagger where I double my money. I don't care if I avoid that, if I'm making 20 or 30%. If I make 10% on average a year for the next 40 years, that's going to make a huge impact on my retirement, right, in the positive, right? But I cannot afford to risk losing half my money by investing in a speculative story. Does that make sense? I hope so. The Tesla, it's phenomenal. Like the growth of Tesla is huge. If we look at overlaying the size of Tesla with the cars manufactured, Toyota produced last year just over 10 million cars. Its revenue was 30 billion. It made a $5.4 billion profit. Ford, just over 10 million cars that it manufactured. Revenue 155 million. 22 million was their profit. General Motors, 7.7 million, right? Revenue 137 million. Profit 118 million. Tesla only produced 388 million cars, which is 3%, 4% of the cars that Toyota produced. Yet, if we go back, it has a market capitalization of 5 times that, the size of Toyota. Its market cap is worth over 850 billion, where Toyota is only 185 billion. Yet Tesla produces only 4% of the cars that Toyota does. Tesla made $3.8 million of profit versus $5.4 billion that Toyota made. Now, that is madness, right? And for that reason, I just avoid it. And sure, Tesla might double in share price over the next 12 months, but that's just like going down to the casino and putting all your money on red. In the current economic climate, we do not need to take on speculative risk to make great returns. Right now, the economy, the Australian share market, the Australian property market, the global investment environment has got a huge tailwind. That's all been fueled by government stimulus. We've got interest rates at record lows. We have government stimulus that's been injected into the global economy. And that's going to mean that the share market over the next 12 months, 2 years, 3 years as a whole should boom like it has over the last 6 months. GameStop's been in the news more recently, right? There's a lot of people that were shorting it, and we've got Robinhood as a stockbroker that has got a lot of individual propeller heads sitting in a home that have bought the stock when some bloke on Reddit put down a comment in the blogs to say that GameStop is a good thing to buy. And now it's been a battle between these propeller heads, these people sitting at home as individual investors versus the fund managers. What it has highlighted is the power of individual investors, where they've pushed this share price up from $10 to $350 in a month. Right? They've pushed it up by a huge amount as they're trying to do a short squeeze on the fund managers, the power of the people, which is phenomenal. Right? We've seen the share price go from 350 down to below 200, then it bounced above 300. I think today it's up 19% on Friday. I think Friday night it was up 19%, which is phenomenal. Right? But again, investing in this speculative stuff is just like a gamble. This is not an investment. It's just a speculative investment. And your super fund shouldn't be one to be rolling the dice with. I've talked about diversification, having a small amount of money maybe to speculative investments, but I'll even go as far as that you shouldn't speculate with any of your super money with these speculative stocks. In the short term, the market is a voting machine. In the long term, it is a weighing machine. The only true long-term dictator of price is profits. With interest rates going down, it's not just us as households that have had our interest on our home loan being cut by a considerable amount, but also the majority of the companies that are listed here in Australia have borrowed money to fund future growth, and they've had their interest rate cut. So if one of their biggest expense is interest, right, they've had that cut dramatically as the RBA has cut interest rates. If they've cut that interest rate, their biggest expense has gone down. Even if they just maintain sales, right, their profit figures are going to go through the roof because they've been able to reduce their expenses significantly. Now, if all the government stimulus, all of the savings translate to actually increase sales, which is what we've seen in the retail sector with JB Hi-Fi, Harvey Norman sales figures. If that actually increases sales, if we've got a combination of revenue increasing and expenses going down, that's where we have a significant impact on profits increasing. That's why we're going to see, I believe, the share price and the market increase considerably as the impact of sales increases and the expenses being reduced is flowing through to company profits. Over the long term, company profits is going to be the dictator of price. If we've got 3 years, according to the RBA, 2024, before they're going to look at increasing interest rates, we've got 3 years of very good times when it comes to the overall economy, the Australian share market, and the Australian property sector. So we don't need to look at the speculative GameStop, Bitcoin, Afterpay, buy now, pay later sectors, because the returns here as a broader sense on an ETF or the overall sector is going to provide you with what I think very healthy returns that have been outperformed over the last 10 years. Balance sheet, the tripling of money in the economy, all this is going to flow through to reducing the unemployment rate, increase certainty, increase spending, and as a result, it's going to increase company profits. Company profits increase over the long term, that means share prices will follow. Does that make sense? Here's the savings figures, best in 30 years, booming economy. So where we look at the 2021 outlook, the RBA came out, Philip Lowe, the governor, said controlling asset prices is impossible. He also came out and said that Bitcoin is not really money, but a lot of people have made Bitcoin, he acknowledges that. So we've got the RBA coming out saying that they're keeping interest rates at 0.1% for the next 3 years. We've got cryptocurrencies, not just Bitcoin, but we've got a lot of different cryptocurrencies coming out. Dogecoin, now worth billions of dollars. So if you think GameStop is wild, have a look up Dogecoin, as there's a lot of different things that you can waste your money away. No doubt, Dogecoin will not be one of the cryptocurrencies that sticks around in 10 years' time. RBA is to set off a raging bull market. This is on the Fin Review late last week. Fund managers and economists say that Reserve Bank's decision to add billions of dollars in more record low-cost borrowing for years out will set off a raging bull market this year with more GameStop-style events, and it will stoke asset prices from housing to aggressive mergers and acquisitions. So if we look at it, it's not my view that just thinks the share market is going to boom or the property market is going to go up in value. But here we've got the RBA designing their fiscal policy and monetary policy to stimulate those sectors. And the Fin Review coming out and saying that we're going to have a raging bull market for 2021. I think we're going to have a bit of catch-up phase where the ASX isn't just going to perform in line with the rest of the globe, but it's going to catch up to be the average of our 5 trading partners. That is India, China, Indonesia, Japan, and the United States. So even if we just meet the average of those, we've got a lot of positive things to enjoy. Interest rates to remain lower for longer. Recession now over, growth set to accelerate. Interest rates generate house prices growth, but local factors determine rate of growth. Dr. Andrew Wilson, my housing markets as one of the property experts. I'm not a property expert, but if you look at the headwinds behind the overall Australian economy, I think the Australian property market is set for a good year in 2021. But obviously, as Dr. Andrew Wilson points out, is that while the general economy has got a big tailwind, local factors are going to determine that rate of growth. We look at property in The Guardian. Australian property prices set to rise to record highs this year, driven by a heady cocktail people seeking a post-COVID lifestyle change. As we've seen, the shift from the people in capital cities to regional areas, or even a shift to move north as people move out of the Melbournes and the Sydneys to the more affordable places like the Queensland economy. I was a bit of a leader in that fact, where I moved from Sydney to Queensland in 2015, but that was more led because of family reasons with 4 kids. I didn't want to be traveling 3 hours to and from work every day. What we've come to realize, our employers, is that people don't need to be traveling 3 hours to and from work every day. And that's what COVID has taught us. So I think across the property sector, from an office space perspective, I think there's going to be less demand for office space in the future, as employers come to realize that they don't need people working from an office where they're supervised. In fact, people can be supervised using technology, even if they're working from home. If they've got 3 hours a day back, some of that can be used to be more efficient in the workplace. Some of it will be more efficient in the household, spending more time with our kids or on lifestyle assets. That's the trend that we've seen during COVID, and I expect that to continue in a post-COVID world. Brisbane gained the most people through net internal migration. So 3,200 people moved to Brisbane, while Sydney lost the most, 7,800. Victoria didn't gain people from any state or territory, lost most to Queensland, with more people moving from Victoria to Queensland overall. So there seems to be more people moving to Queensland as they're seeking a better climate, as we've come to realise that we don't need to work in Melbourne or Sydney. Many of us can work from home or in those more lifestyle attractive cities. Brisbane property market, it's a smart investment property. As I said, I'm not a property expert, so I've drawn on some other experts or those experts that have written in newspapers. What do we got? Median monthly prices rose in Brisbane by almost 1% over the month of December 2020. And we've had an increase in the median price of a property in Brisbane, which is great. If we compare Sydney, Melbourne, Brisbane, Adelaide, Perth, the monthly change is all a positive for all of those cities. The only one to record a negative increase in dwelling value on the year is Melbourne, which is down 2.1% according to Smart Property Investment. Elite Agents, Perth, now Australia's fastest growing property market, which is interesting, but that's probably more in response to the last few years where it's probably been the worst performing market. So it's just a rebound from those lows. I won't go through these, the 10 predictions for Australian property markets. What I'll do is I'll send you these copies. I know I'm conscious of time. Urbanisation on hold, but cities will re-asset their strength. Thinking big on the next wave of transport and social infrastructure projects. Offices will adapt to remain key to collaboration, training, cultural cohesion. Offices will adapt to remain key to collaboration, training, and culture. As I said before, landlord-tenant relationship will need to adjust. Shifting patterns of prime residential demand. So we've got lockdowns or border shut. People are moving to benefit their lifestyle rather than their working environment. Short supply of prestige residential rentals, certainly the case here in Southeast Queensland. Investment performance will be relatively strong compared with previous downturns. Overseas investors to drive the office market in 2021, which is interesting. Low return environment will drive appetite for debt strategies and boost competition in non-bank lending, which is good. Interest rates are low, balance sheet is high, with a lot of money in the economy. It's triple. We're expecting things to be very good for the next 12 months. Where to invest? As I said, I don't try to pick the next GameStop or Bitcoin. I don't try to get lucky. I merely stick to assets that have gone up in value over the long term. They've got a long-term track record of providing superior returns to investors, consistent returns over 40 to 50 years. So I stick to assets that provide an income, and that has been investing in our economy, investing in the top 200 companies in Australia. So looking at the ASX 200, we'll be coming out with another ASX 200 investment in the next few weeks. So watch your space. Buy well and never sell. The top ASX 200 companies. We don't need to be stock specific in the current environment. Just taking exposure to an ETF or one of the tailored investment solutions ASX investments can provide you with that exposure if you want leverage. Same thing with Berkshire Hathaway. Berkshire Hathaway provides you with exposure to almost 100 of the best companies in the world, following arguably the best investor of all time, Warren Buffett. Remember, two picks, they've been the same as what they've been over the long term. Stick to quality, buy for the long term. Don't be lured to the next quick buck scheme. During these times, by all means, reflect your circumstances, adjust your investment strategy accordingly, but stick to quality. We can stick to quality by backing the Australian economy. Right now, we've got a huge tailwind, which I think is going to influence the overall economy and the Australian share market, property market. Internationally, it's the same sort of thing, which is why we want exposure. The world's best investor, Warren Buffett. So that's it from me. Sorry, I've been dragging on. It has gone a little bit over time. I haven't looked at your questions. I apologize. We have a heap of them. Let's go through some of them. If I go back, sorry, I didn't get back to them earlier. Thank you, Justin and team SMSF Club. Thank you for what you do, loving what you do, and helping us investors who are emotionally invested, keeping us informed and on track. Yeah, thank you. Really do like that feedback. We don't get much feedback. We try to stick to the same investment philosophy and not fly to the next quick buck scheme. It takes a lot of patience from us. From your perspective, you might not hear from us all the time. You might think, hang on a minute, they're not doing anything. But look, what we've done over the last 5 years, 10 years, 20 years as investors, certainly over the last 9 months, is to provide certainty in a very uncertain world, hopefully to provide you with confidence to invest when there's blood on the streets. If we've done that, we've done our job. If we haven't done that, then unfortunately we can't control your decisions as an investor. After all, it's your self-managed super fund. It's not my self-managed super fund. It's your self-managed super fund. You're the trustee that's ultimately responsible for your decisions. If you have invested, then look, you should be patting yourself on the back, because your income in retirement is going to be a lot better had you invested over the last 9 months. And even if you didn't sell, like few investors that call us up and have dumped everything in a frenzied panic, and we've tried to talk them off the cliff. And unfortunately, they've gone through with those decisions. Some people have sold property at the worst possible time rather than sticking a long-term view. So what we try to do is just make sure you stick to the long-term investment philosophy as to whatever those goals might be. And after all, superannuation is for the long term. So thanks for your feedback there, Catherine. Would all this debt not limit growth at some point in the future? Look, that's an interesting point. I generally, what happens is that when a government or a RBA or any government stimulus, whether it's interest rate cuts or quantitative easing, printing capital, injecting a lot of money in the economy, that would generally have an impact on inflation. Right, dropping money out of helicopters for everyone to benefit, which is essentially what's happening and has happened in the US since 2007. That generally has an impact on inflation. When inflation increases, it means the cost of today's debt is being borne by future generations in price growth. But over the last decade or 12 years, 13 years from the GFC in the United States, printing all that money, cutting interest rates actually hasn't had an impact on inflation, which is unbelievable. Right now, we haven't had an impact on inflation. We haven't seen the impact on inflation. So the only concern is if all this government stimulus actually flows through to an increase in inflation, a dramatic increase in inflation above 3 or 4%, then that is going to be an issue for us all. The government will be forced to increase interest rates and cut their quantitative easing. But right now, we don't have inflation. And over the last 12, 13 years in the United States, inflation hasn't been a side effect of huge government stimulus, which is great. So provided our economy, our government, our RBA aren't increasing the debt levels here in Australia at the same rate as everyone else around the globe, future generations are going to be better off for it. The Australian economy will become more competitive. The Australian currency will become more competitive. That's the key consideration. We've just got to do less than our competitors, less than other countries. At the moment, we've got a lot of room to move, which is great. There's heaps of questions here. Sorry, I just go through. PEG Series 4, that is not a Tailored Investment Solutions investment. The last investment update that I received from the guys that put together that investment is that it's down, and that's down due to the negative performance of Insurance Australia Group. The maturity of that is coming up in the next few weeks, so we'll be doing a co-presentation with those guys at SMSF Investment Solutions to talk about what options you have moving forward. But right now, IAG and CSL are down, which has had a negative impact on PEGs. I think it's down about 10%, so it's not a huge amount, but it's at that negative level. It's not a positive for PEGs, which is unfortunate. But hopefully we take the long-term view and we'll go from there. Is Berkshire Series 2 going to mature or expire come 18th of February? It is going to mature. We will be coming out with another Berkshire Hathaway investment that those people in Berkshire Hathaway Series 2 can roll into. Series 2, since inception, you've made a return. The returns have been okay. It hasn't been to the same level that Berkshire Hathaway has experienced over the last 50 years, but it's still a positive return. Given the last year has been COVID, there is a return expected to be given to investors as a final value on the 18th of February. We will have an option for people to take out a new Berkshire Hathaway investment, which is what my general advice recommendation will be. So I'll get to that when it comes up. We'll be coming out with in the next week a investment update for those investors, and we'll be doing a webinar specifically on that investment. So there's a few questions on Series 2. There is expected to be a final value. It's not that much because we've been paying out gains along the way. The structure of the investment is gains up to 10% gets paid out every year. It's like harvesting the growth along the way. But right now where we are, there is a return to investors as a final value, but it's not a huge amount given that we have been paying out investors on a yearly basis. overall, the return has been quite fair for investors, and it's positive, which is good. Gold, yep, gold is up. Gold has been one of our best investments over time. The reason we bought that out was for diversification, and it was a hedge just in case something like we've experienced over the last 12 months has happened. In fact, many people say you need to diversify to reduce risk in a portfolio. I think in today's modern world, and it has been for the last 20 years, whether it's shares or property, they're all somewhat correlated, and we saw that in the GFC. We saw that in COVID when all share markets around the globe fell, and property, if you're looking at the property indexes, they fell with it. The only true form of diversification is to invest in an uncorrelated asset. The only true one as a defensive asset has been gold. Over the last 12 months, that has certainly been highlighted as the gold price has gone up almost 50% when all other asset prices have gone down. And yet, when properties and share market have rebounded, and look, all except for Australia, when we look at the Dow Jones, the Nikkei, the Nasdaq, the Hang Seng Enterprise Index, the Nifty 50, they've all recovered all of those losses that they've experienced. So yet gold has maintained its value pretty much. It's given up a little bit, but certainly not gone back to where it was. It's still up 40–50% from its from where it was 12 months ago. So gold has been a great asset for those of you that are invested in gold as an asset class in your portfolio. The Tailored Investment Solutions gave you leveraged exposure to gold, which has been a phenomenal investment. Been over the last 18 months, to no surprise, the best investment in our basket. So look, I'm conscious of time. All those other questions we'll respond to in email. I think I've covered most of them. As I said, it's a record number of people for the last 18 months, 2 years that have tuned in tonight. So thank you for tuning in. Thank you for taking your SMSF trustee obligation seriously. Hopefully you learned a little bit from today's presentation. Anything that you need to take away, some of the key take-home things is stick to the long term, buy quality assets, diversify, buy well and never sell. And for me, that's got to do with taking a long-term view when it comes to investing. So thanks for investing. Thanks for tuning in, and good night.